Good morning, everybody. Welcome to this edition of Private Affairs Comes to Life. I'm Andrew Playle, and I'm the head of the firm's private wealth sector. Today, we're going to be looking ahead to the next general election. And to help me do that, I'm going to chair a discussion with two panelists, Catriona Attride, who is one of our partners, who's going to speak particularly on pensions, capital gains tax, and IHT, from the perspective of the UK, and Sarah Cormack, who's going to follow that with a discussion about how a possible change of government or possible new policy by the current government might impact on non-domiciliaries. Now, we don't know exactly when the next election will be, but we know it's going to be sometime either during 2024 or at the latest January 2025. We also, of course, don't know what the outcome of that election will be. So it may be a surprise for some, it may be exactly what people are expecting. We haven't seen any manifestos from any of the parties yet. It's too early for that. So everything that we talk about today will be based on really just what we're hearing the major parties talk about. Of course, we don't have a crystal ball. We cannot be certain of what policy will be, but there are definitely some themes that are emerging. So I'm going to just bring Catriona in now and talk to her about, perhaps the first topic might be pensions. I think many people who are on this webinar will be very interested in whether there could possibly be another raft or maybe some small changes to pension legislation. Catriona.
Yeah, I think pensions is a really interesting area and one that really could be open to changes. It's one that is always open to changes, as we know, things change all the time. The current government have already announced the abolition of the lifetime allowance as of April next year, which is really quite generous. Labour have already confirmed that they would reinstate that if they were to come to power after the next election. So depending on what the outcome is, losing the lifetime allowance is probably going to be fairly short-lived or quite possibly short-lived. So I think that's the first thing that we can almost, you might want to even have a bet on in all of this. Over the summer, the HMRC mooted withdrawing the tax-free drawdown available to beneficiaries of a pension holder who has died before the age of 75. We have the system at the moment where if you die before 75, your beneficiaries can extract your pension free of tax. And if you die post 75, then any drawdown taken from the pension is subject to income tax at the beneficiary's marginal rate. So there's a big difference at the moment between the pre-75 and post-75. So if they were to take away the tax-free nature of drawdown for the pre-75 death, that would have quite a significant impact. We thought that something might come out in the autumn statement on this, but actually the Tories seem to not be pursuing it. But my view is that we're probably still at risk of it, regardless of which government we might end up with, because it is something that HMRC, I think, are quite keen on. And I think from where I look at it logically, not that logic is always how tax works, pensions are inheritance tax-free on death, and a lot is made of that. But if you do die post 75, actually there is still quite a lot of tax that can come out of the pension in the shape of income tax. And if a beneficiary wanted to take a large chunk of money out in one go, they're going to potentially be paying all 45% tax on that money rather than 40% inheritance tax. So if they do withdraw this pre-75 side, query whether they would then need to then take away that IHT free status of the pension, because it's almost a bit of a headline. So I think that's probably what I think where we might end up on pensions.
Thank you. I think that point around the income tax is very interesting. So I think you're saying if there was to be income tax, even if the pension member had died under 75, income tax on their beneficiaries withdrawing, then that could have a major impact on quite a lot of clients, couldn't it? Quite a significant change.
Definitely, definitely.
How about capital gains tax? I know we've talked before about what might be on the horizon. What's your feeling about the direction of travel there?
Yeah, I think the CGT one's a really tricky one, because even under the Tory government, we've had these pinch points where people have panicked thinking that the rate's going to go up, because we've had such a low rate of CGT for a long time. And I mean, I remember back in 2010, we thought that capital gains tax was going to go up to 40 or 50%, and it actually went down. In terms of a change of government, I mean, in August, Rachel Reeves, the Shadow Chancellor, she ruled out introducing a wealth tax or increasing CGT rates. Now, that was at odds with Angela Rayner, who is much more left of the party, obviously, who suggested that they would look at it. But I think the general census is that maybe they won't. The taxpayer is obviously nervous about the possibility, and actually it's been reported that in the tax year 21-22 there was a record 16.7 billion of CGT receipts, and that has been put down to people crystallising gains ahead of when we thought last that the CGT rates might have been increased. So the government's had a bit of a windfall on CGT. They've already, under a Tory government, had a big chip at it as a tax. So from what was entrepreneurs relief is now business asset disposal relief. We've only got a lifetime limit of £1 million, whereas we used to have 10 million. And so, we've reduced a lot of the reliefs from that side of things. And also they're chipping away at the annual allowance. It was over 12,000, it's gone down to 6, and then next year it's down to 3. So I don't know if we think that actually CGT is one of the taxes that they are going to really go for, either party. I think I'd be surprised if the rates were aligned with income tax.
There was a lot of talk a few years ago about that alignment, wasn't there? There were even government and all parliamentary group papers written about it. Do you think that's gone away now?
My guess would be yes. I mean, in Labour's last manifesto under Corbyn, they talked about bringing the rates up, but also reintroducing indexation allowance, which those of you who are old enough on the call to remember, we haven't had for some time. But there was a feeling that that would actually work to the advantage of property owners, because it would wash out a lot of the inflationary effects. So my instinct is that they have simplified CGT quite a lot. After all the reports on tax simplification, I think we're probably as straightforward as we're going to get on it.
That's really interesting. Do you think that there's a different view on IHT though? Do you think that's going to get? I mean, we've seen things with the Conservatives talking about possibly abolishing it. Labour Party, what's our view on that? What's our understanding?
I think it's highly unlikely that inheritance tax would be abolished. I think it was quite convenient that the press really went to town with it before the last before the autumn statement, and then of course nothing came out of it. The receipts on inheritance tax is one of the lower taxes, although it is going up, because the main thing with inheritance tax is that the nil rate band has not kept up with inflation. So the nil rate band has been stuck at 325,000 for as many years now as I can remember. It used to go up every year. And that is what's catching more and more people. So is it likely to go altogether? I think not. If the Tories did do something to get rid of it, I think it's something that Labour would definitely bring back in. I think with that close to an election now, I don't think they're going to do anything with it as it stands. The obvious thing in my mind, again, applying very logic, I'm very simple in in my thinking, is all you really need to do with inheritance tax is increase the nil rate band significantly, and probably £1 million each per person, because that's going to stop people with higher value properties, but normal people, so particularly in the southeast, from falling foul of inheritance tax, and probably getting rid of then the nil rate band, because in my view that's quite a discriminatory tax. You only get it if you've got children or children of the family, and that doesn't seem fair on people who can't have children or chosen not to have them. So I think if they just did a very straightforward higher nil rate band, that would probably solve a lot of the problems and a lot of the unpopularity around inheritance tax. I think the big thing on it is business property relief. And I think if we're expecting any changes, that's probably the area that we'd expect to see it. Business relief is a very generous relief. You're getting 100% relief on an asset if it is qualifying. So once you've owned an asset for 2 years and it satisfies the wholly or mainly test, which essentially means that it's 50% trading. Now, that is at odds with business asset disposal relief, where the requirement is for 80% trading. So there is an obvious gap there that it would be quite easy for either a Labour or Conservative government to align the two. And it almost seems to be crying out for that. Now, that is not good news for a lot of people, and particularly when we look at clients who've got farming enterprises and relying on agricultural property relief, because we've got something known as the Balfour claim, which relates to a case where we've got farming and we've got farmland, but because of diversification, not all of the activities qualify for relief. But when you put them together, you've got the 50% wholly or mainly, and therefore you get your BPR. And that's been a really valuable planning point over the years. We think there's still some planning around those sorts of things, and it might be that people want to start looking at that sooner. So, for example, if you've got some land which you're thinking of putting, say, solar panels on, then before you go for the planning and the value of the land increases, perhaps pop it into trust while it's got the lower value, possibly still got some relief attached to it from an agricultural property relief point of view. So I think there's some things that you can do. But I think that would be the obvious one for me. And then I think the other thing from a BPR point of view is whether they make it harder to get. So, for example, people at the moment use BPR investment products or use AIM portfolios, whether or not, maybe they put in a requirement where you've got to have a percentage, a certain percentage ownership or control, perhaps, to get the relief.
Just on that last point about business property relief, AIM shares, we see a lot of people don't reinvest in AIM shares as something that currently qualifies. Do you think there are other ways they could just tighten up that relief other than perhaps the trading requirement you talked about? Do you think we could just find less businesses qualifying, or a hardening of an approach?
Yeah, I think that could be right. I think for me that the obvious bit would be the percentage of shares that you've got to have a certain amount. So a little bit like if it's a public limited company, you've got to have a certain percentage before you qualify. With AIM, it doesn't matter. You just have to have a number of shares. I think they might tighten up on the accepted assets side of things, which is the part of the business, the assets that don't qualify for relief, which is traditionally too much cash being held, or assets that are used for personal, perhaps they'll extend that out a bit. The only reason why you query whether they would do that is because it does feel like sort of tinkering around the edges, and it doesn't feel hugely meaningful. So, as I say, I think the main obvious one would be the trading test.
How about lifetime gifts? So you touched on sometimes people putting assets into trust ahead of an event, for example. I certainly remember in the past, leading up to more than one budget, people speculating, are they going to extend the period for lifetime gifts from currently 7 years, and it's been 7 years as long as I can remember. Anything that we're picking up around that?
No, so you'll remember a few years ago there was talk about your nil rate band and how often you'd have that and how often you could use one, and that was a big pinch point a few years ago. I don't know if it would. I think if they did something radical, so for example, the US have a system where you have a really huge, a very significant over $5 million that you can give away during your lifetime, but it's one allowance, and once you've used it, you've got it. What we've got is 325 every 7 years with your taper relief, which sort of complicates things a little bit. But it seems to have gone quieter around that piece. So I don't think we're expecting anything major there.
I just got one last point I want to just see what you think about. So we saw in the paper a few months ago around this idea that the Conservatives could abolish inheritance tax relief. If they did, do you think that would be the end of it? Or could you see something that replace it that isn't quite as good as that sounds? So, for example, other jurisdictions look at capital gains tax in different ways.
Yeah, I think you definitely wouldn't get, or definitely, I'd be surprised if you'd still get the free CGT uplift on death that we currently get. So at the moment, gains get washed out on the death of someone. I think you'd definitely be losing that. I think then we probably would find CGT rates being more aligned with income tax as well, if they were to lose the inheritance tax. We could even end up in a system where they have, particularly in the continent, where it's a beneficiary recipient tax, depending on your close proximity to the closest in proximity to the person who's died. But yeah, I think as a minimum, if they got rid of inheritance tax, and I really don't think they will, but I sometimes wrong, not very often. I think CGT would become much more of an issue than it is at the moment.
I mean, there's certainly other regimes, aren't there, around the world, which a new government or the same government, perhaps re-elected, could look to say, yes, we're abolishing this, and that makes all the headline, and then by the back door bring in different ways of taxing assets on death, etc. Thank you, Catriona. I'm going to just sort of turn our attention now to Sarah. Sarah, you do lots and lots of work with an international flavour, the vast majority of your work. And, we talked before about what might happen in the space of non-DOMs in terms of, again, it's something that's been in the headlines a lot. The Labour Party in particular have made quite a lot of noise around this space. And I think it's quite, the papers do get very interested in it because often the non-DOMs sometimes get a bad press and the papers like to jump on that. Why don't you perhaps just take us through what do we mean by non-DOMs and the regime that applies to it, and then what might we see changing in the future?
Yeah, thank you, Andrew. I mean, I think, just referencing your point on the press, really unhelpfully, a lot of the press over the last few years, around the concept of domicile and the remittance basis of taxation has been deeply inaccurate and plain wrong. I think the reporting, the current interest, was around Rishi Sunak's, wife and her electing to be non-domiciled. I think I just want to make very clear at the outset, there are no loopholes here. You are domiciled or you are not domiciled in the UK, and then there is a legislative framework which enables people who are domiciled to claim, who are not domiciled, to claim the remittance basis of taxation. There are no loopholes. There's no dodgy dealings. It is just the law. And so really, it's down to the governments to decide what that law, should be, I think, rather than the implication that there's been of late that this is all very murky. So essentially what we have is a system that means that people who are not domiciled in the UK can elect for up to 15 years to enjoy the remittance basis of taxation, which means during that 15-year period, they are taxed only on UK source income and gains, and offshore income and gains only to the extent that those income and gains are brought into the UK. During that 15-year period, there are various cut-off points at which they have to pay for the privilege to claim the remittance basis of taxation. So once you've been resident in the UK for 7 out of 9 years, you pay £30,000. Once you've been resident in the UK for 12 out of 14 years, you pay £60,000 to carry on enjoying the ability to claim the remittance basis of taxation. Once you hit the 15-year mark, you become deemed domiciled in the UK, regardless of what your status is as a matter of law. And at that point, HMRC and the UK tax rules treat you as though you are within the scope of UK tax on a global basis, just like me. what we have seen, I think, over the last, kind of 15 or so years is a gradual whittling down of those benefits around the remittance basis. It kind of all, I think, really kicked off, back in 2007. At that point in 2007, there was a separate regime for income tax and capital gains tax and inheritance tax. For inheritance tax purposes, it had always been the case that once you'd lived in the UK for 17 out of 20 years, your worldwide assets were subject to UK inheritance tax. But you could live in the UK claiming the remittance basis, provided you had the requisite intention to leave the UK at some point for your entire life and still claim the remittance basis. Back in 2007, the Labour noise around the perceived unfairness of that situation got a little louder, and at the party conference, there were some real commitments made to changing this so-called loophole and reducing that benefit. The Conservatives at that point came back and said, okay, yeah, we do need to do something around this because we are losing revenue. And they introduced this charge. So at that point, it ceased to be something free. You had to pay to claim the remittance basis. And things have just kind of cascaded, and tumbled from there. And where we ended up back in 2017 was a situation where the inheritance tax rules and the income tax and capital gains tax rules were largely aligned, and the length of time during which you can claim the remittance basis of taxation for income and capital gains tax was fixed at 15 years. So people who are long-term residents of the UK who are not domiciled in the UK can only enjoy that tax break for 15 years now. So clearly where we are now is Labour are saying we will just abolish this, and we'll introduce a new regime designed to target top international talent moving to the UK. And so I envisage that, what they mean by that is some kind of regime whereby, people who are moving to the UK for employment purposes get maybe 5 years on a reduced remittance basis. And then when they, leave, they leave. It's clearly going to be a regime that favours workers over, the independently wealthy or business owners who are, not undertaking employment in the UK. What I think is really interesting is just actually looking at some of the figures, because what Labour think, based on some of the research that's been published, is that if they reduce/abolish the remittance basis of taxation, they will raise £3.2 billion, which, for a start, is not that much. I mean, people talk about inheritance tax. I mean, Catriona, you're talking about inheritance tax. I think inheritance tax raises about 11 billion. And is deeply, deeply unpopular. People don't think it's fair, even if they don't have to pay it. Remittance basis, deeply, deeply unpopular, but for different reasons, because they think the people who are enjoying it shouldn't be paying the tax. But Labour thinks it will raise 3.2 billion. So it's not the massive kind of tax win that people, I think, believe it would be. And if you distill down into the figures a little more, it becomes ever more fascinating. The statistics I've kind of rummaged around and come up with is in 2022, there were around 55,000 people in the UK who thought that they were non-domiciled in the UK. So that's about 0.08% of the British population, not very many people. In 2021, because all these stats don't quite align, 37,000 people, so not everybody who said they were non-domiciled, 37,000 people claimed the remittance basis of taxation. Of those 37,000 people, only 2,100 of them paid the remittance basis charge. So that means there were a chunk of people who were below 7 years, who may have been claiming the remittance basis, but they didn't pay the charge because they didn't need to. So they were very short-term residents. And then there were just over 2,000 people who had been here 7 out of 9 years or 12 out of 14 years, who paid £30,000 and £60,000 respectively. 1,600 people paid £30,000, only 500 people paid £60,000. And I think what's interesting here is that the cut-off for it to be economic, for it to be worthwhile making that payment, is an income of £133,000 a year, or £214,000, £100,000 gains. So actually, there were only 500 people claiming the remittance basis of taxation in 2021 who were earning more or had global income of more than £100,000, which is a very small number. So if you kind of roll that forward even further, Labour think they're going to get £3.2 billion from these 500 people, which means that they're looking for about another 6-7 million from 500 individual people. Now, my take and my experience when there have been, these changes, is that the very wealthiest people, who are the people who probably are the ones, who could, stump up this, or have that level of income. Not all of those 500 people will have that level of income. The very wealthiest of those people don't actually need to be here. They will probably have a relatively small footprint in the UK. They may well, obviously they'll be tax resident here, but they probably only spend 6 months a year here. The rest of the time, they're probably in holiday homes or working overseas, or just generally traveling. And those people who will be hit the hardest by the change of rules will be the people who can afford to be the most mobile. And so those people will leave. And we've seen that before. We saw it in 2017. I saw it in 2007. The people who have only a kind of loose footprint here will leave. And because we've had since 2015 a statutory residency test, it's really important to bear in mind that for those uber wealthy people who have the financial means to be nimble in terms of where they live and how they lead their lives, they can very, very easily, with those statutory residency rules, leave their wife, leave their kids in school here, and become peripatetic, internationally mobile. School holidays are spent at a holiday home, kind of every other weekend spent in the UK. It suits their lifestyles. It's not that hard for them to leave. So I think my take on it is that Labour Party likely will do something. They likely will abolish it, but it is not going to raise the tax that they think it's going to raise. And I think, the wider impact on the economy in terms of what some of these very wealthy people bring into the UK, may well outweigh the benefit of what they do. The Conservatives, I suspect, probably won't do anything very much, maybe reduce the 15 years, down to 12. But my guess would be that if the Conservatives stay in power, it will be pretty static. It's probably also worth mentioning the Lib Dems. They're always a bit wishy-washy on domicile on the remittance basis. And they, like to talk about it being a loophole. But again, my sense is from various comments made, that they would be unlikely to go for a wholesale abolition. They would probably support a narrowing and a reduction.
Just on that remittance basis point, I think what you're saying is that's relevant to people who are resident here based on the statutory residence test.
Yeah.
So just one thought I've got is, would there be a sort of backdoor way, if you like, saying we've not actually changed the domicile rules, but we've changed the statutory residence test? Yeah. Is that a possibility?
Yeah, and that was when I was thinking about what I was going to say and the points to highlight. I did think, as I was looking at it, we're in a really and actually a really positive position in the UK now, I think, with our statutory residency test. After years of uncertainty, we actually have, although slightly fiddly in places, a pretty clear set of rules that enable people to manage their time and know with certainty whether they will or will not be within the scope of UK tax, which has always got to be is an appealing degree of certainty in an uncertain world. But yeah, you're quite right, Andrew. I wonder whether, there is a little backdoor there to making it harder for people to cease to be UK tax residents, and easier for them to become UK tax residents by manipulating those rules around the statutory residency test. That to me actually would probably be the thing that makes the most sense. You know, in terms of you know, kind of increasing the actual kind of tax take, and reducing the flexibility available to the very wealthiest people. But on the other hand, I remember very clearly the angst and pain of that statutory residency test being drafted and introduced. So I wonder, you know, what the appetite of that might be. It's much easier to reduce, you know, a time limit from 15 years to 12 years, or, you know, 5 years, or just say it no longer exists, than it is to start fiddling and playing with the minutiae of an already quite complex set of legislation, I think.
Yeah, I definitely think that's just, you know, I'm always interested in, are there other ways of them achieving the same sorts of things? So I think we often talk about our non-dom rules as if we're the only country that has that kind of regime, but of course we're not, are we? What else is happening around the world that, you know, imagine someone who decides this is the breaking point. What might they do? What might they look at?
And I think that, you know, is actually a really important point. You know, we are not on our own in having a regime like this, and other jurisdictions in Europe do have regimes which are arguably more generous than ours. I guess the difference is that the UK and London, you know, is a global financial centre, whereas some of the other jurisdictions that offer these regimes are maybe less appealing to internationally mobile people because of language barriers, lifestyle, education. The other, I think, obvious, you know, European kind of alternatives for international people looking for a footprint in Europe have always been. Do you like the way I'm still referring to the UK as being part of Europe? It's quite kind of we have Italy has a fantastic sort of remittance regime, but actually when you look into it, it's not a remittance regime at all, because actually you pay a lump sum, you get to live in Italy, and you don't pay tax on your non-Italian source income and gains, but you can bring it into the UK, into Italy. Whereas the UK remittance basis is very much, you don't pay tax as long as you keep it out. You pay tax when you bring it in. So the Italian regime is very you know, actually very appealing to some people, I think, depending on their lifestyle, time of life, etc. I think the downside with the Italian regime in the early days was that it was very new, and it was brought in during a period of financial instability in Italy. So there was a fear when it was legislated that it was going to be withdrawn the following month. It does seem to be pretty stable. So that's definitely an option. Switzerland has always been there as an option because they have a forfeit or a lump sum possibility for international people. It's expensive and it can be quite hard to manage, but it's doable if there's enough money at stake. And my suspicion is the very wealthiest people who seek to leave the UK as a consequence of any changes which are not beneficial to them probably would look to Switzerland, because they would be able to afford in a meaningful way a Swiss forfeit arrangement and continue a very similar way of life. Portugal also has a regime that has actually been changed this week. It's less generous, but it ensures a reduced tax rate and a lower tax rate than somebody would be paying in the UK for a 10-year period. But again, because there seems to be some kind of instability, political, kind of instability about, and mixed views on these processes, you wonder how kind of stable they are. The appeal of the UK has always been that the remittance basis was not a loophole. It has been, our law for as long as there was as long as there's been taxation in the UK. And these kind of copycat regimes have been very new and have been designed to attract people to move to those countries. But there are options, and my advice to my clients, at the moment is have a flee plan. If it really is as bad as we think it could be, and the impact, on you is unpalatable from a financial perspective. What is your backup plan? So I think a lot of those 500 people will be looking at what other jurisdictions, they could move to, possibly, leaving wife, kids, etc. behind.
Thank you, Sarah. I'm going to just, in a few minutes, I'm going to just start dealing with questions that are coming in from people. So for those who are joining us and have joined us earlier, if you've got a question and you've not put it in the Q&A yet, please do so. It would be good to make sure we've got as many as possible. Often we see common themes coming out when there are a number of questions in there. Before we do that though, Sarah, we really focus in there particularly on resident non-domiciles and the remittance basis, and I suspect that is the most relevant aspect of the non-domicile discussion for the purposes of this webinar. But of course, we deal with clients who are both non-resident and non-domicile, and people might think, well, why do they need to think about IHT, for example? But of course they do. Perhaps just spend a few minutes explaining why it's relevant, and perhaps what could there be in terms of changes that might impact those people.
Yeah, I mean, I think that, yeah, that's right. We focus on resident non-domiciled individuals, and I think, most non-resident non-domiciled individuals, may wonder why they need to be bothered about UK taxation at all. But we've had, as everyone on the call will be aware, a kind of massive taxation creep in relation to UK property, so far in relation to UK residential property. And many international clients do have a property footprint in the UK. And back in the 90s, the typical way of holding a property in the UK was to hold it via a offshore company to shelter from inheritance tax. And that was very much, what everybody did. There were then, I think, as we progressed through the 90s into the 2000s, concerns about the other implications of that kind of holding structure. The Dimsey and Allen line of cases about management and control of companies, which would cause UK tax issues. And then we've just seen this, I guess, assault on the ownership of UK residential property, and actually quite a significant shift in the basis of UK taxation, because UK taxation, from the perspective of income tax and capital gains tax, has always been residency based. But where we ended up was this attack on inheritance tax structuring for residential properties has then actually extended to capital gains tax exposures for holding UK residential properties. So we now have a situation where, holding a UK residential property through a company gives you no inheritance tax protection. It can give you an annual charge, the ATED charge, which I'm not sure, kind of how many people, pay now. And it gives you a capital gains tax liability, because non-residents are now subject to capital gains tax in relation to holdings of UK residential property. Obviously more recently, there's, the rules have become more and more nuanced and complex with the introduction, of the indirect holding rules, property rich companies. But all of this only applies to residential property. So those international clients who we advise who have invested in residential property already know what the score is. But those, I think, who have invested into commercial property in the UK, that seems to me an area of vulnerability. And as Andrew said, looking at the easy ways to get more tax, just changing that clause that says residential property to property, could expose a far greater number of people to a range of UK taxes in respect of that UK based asset class.
So if you were a client who had commercial property in the UK, perhaps you helped them structure things in the past so that asset class wasn't exposed, because of course if you didn't do anything clever, it would be anyway. But if you'd helped structure it, if you were that client looking forward, and I know none of us have that crystal ball, would you be thinking about taking action now? Would you just wait to see what might change? Would you want to start the discussion now or later?
I think you'd want a discussion to start the discussion now, but you know, as we know from our experience trying to de-envelope structures for residential property, it can be easier said than done, particularly when there's borrowing in a structure because of the SDLT. My big concern, you know, with this as well is if we see either watering down or a withdrawal of the remittance basis of taxation, getting these assets out of structures, particularly where they involve, you know, companies and trusts, is going to be extremely expensive in tax terms. So we can start the discussion, but I think there are some hard decisions to be taken, you know, and collapsing a structure now, you know, while there's the remittance basis, you know, taxation, you know, may well be, you know, the best thing that people can do, you know, but on the other hand, you know, the problem with property, I think, is always getting it out of the structure, you know, triggering a gain, whether it's a deemed gain or a real gain, you know, is doable. But then actually getting the asset out of the structure is much harder, and much harder to do that without triggering a real and immediate tax liability, which I think will become next to impossible to do if the remittance basis is removed as well, because obviously that will have an impact on trusts.
Thank you very much, Sarah. I'm just going to start on the Q&A now. And as I say, people should still feel free to post things in there. I'm just going to start with a question for Catriona. So we talked about business relief, or business property relief, as we were used to calling it, and how that could become tighter. It could be harder to get on things like maybe AIM assets. It may be that you've got a genuine trading business, but you've got other things within it which are already troubling you, but you know, the rules tighten so that those things might be the difference between getting it or not getting it. So a little bit like my question to Sarah, you know, if you have a client who's in that situation, is it something you discuss now, or do you just wait to see if those things happen? What might your discussion be, Catriona?
So I think it's really important, with or without an election and with or without changes, that business relief is always at the top of the agenda. People assume that they're going to get it, and then when you lift the lid and look at it, it's not always the case. And so it's really important that you work with your advisors to look at, actually, are you even going to qualify for the relief at the moment? Have you got accepted assets in there? Because there are restructuring things that can be done in order to make sure that you do get the relief, because it is an all or nothing relief. So if, for example, we ended up in this world where, say, it is an 80% test instead of a 50% test, if you've got 80% trading somewhere in your activity, let's at least get the relief there. And you know, maybe you just need to start looking at demerging and looking at your companies and restructuring to make sure that anything that isn't going to qualify is out of there. There is also, we do quite a lot with business owners around what we call pre-exit planning, where if an exit's on a horizon and people know that they're not going to need all the proceeds themselves, then they can gift some of their qualifying assets to a trust. Normally you can only give your nil rate band of 325, but where an asset qualifies for relief, there's no limit to what you can give. And for those that are interested, I did a recent webinar which is still available, which goes into that in a bit more detail. But there could be an opportunity ahead of a change in government to look at people who are thinking maybe of gifting those shares, who perhaps are safe on the 50% but are going to be in trouble if the tests change, and it's the right time for them, that they might want to bring forward gifting shares to trust. There are advantages to doing it sooner rather than later, because once the trustees have owned the shares for 2 years, they qualify for business relief themselves, which can have other impacts. So I think, yes, it's definitely worth having conversations, and obviously every person's situation is different. But I think taking advice and just thinking around those things, it's probably a sensible time to be doing that.
I think one point around that, getting ahead of it, if you like, and at least with the discussion, is these things often do take time, like the analysis that needs to be done. It's quite complex. Sarah talked a little bit about, you know, you might have lending in a structure, etc., etc. You can't just suddenly jump and say, don't ring us the day before the election and say, can we do X? Often we need to work really closely with other advisors, the family office, all of those things, even just to get a plan together, a steps plan, as we often call it. I also find that point you made, Catriona, interesting about it might be the right time to think about giving anyway, or it may, it might be that these kinds of potential political changes are the things that prompt us and prompt the clients to think, maybe I should be doing some lifetime giving anyway, regardless of what's down the track. And then this is the catalyst for doing it. I've certainly got that discussion going on with a client with actually an offshore structure with commercial property in, where we're starting to have the discussion that had it been a more domestic client, we would have been having the discussion years ago about giving, whereas we didn't need to. It looked like the perfect structure. So we're obviously taking great care over whether we do make a move or not for them. Sarah, I'm going to come back to you with a question that we've got here, which is, what else, other than the things you talked about, what else could remittance basis users be doing to protect themselves?
Yeah, again, it's difficult because you don't want to make a situation worse, for a client when you're planning. But I guess the one thing that occurs to me, is maybe the most valuable of offshore assets. Looking at rebasing those, it seems to me that it would be quite difficult for somebody who is currently claiming the remittance basis and realizes again offshore, during a year in which the remittance basis is claimed. It would be quite difficult for that gain to be caught, in the future, because that would be retrospective. So maybe look at kind of rebasing exercises, particularly if there is going to be a monetization event coming up in the future, so that if you've lost the remittance basis, that gain is the gain that actually is immediately taxable is reduced. Maybe the same with income. If there's income in a structure that you can extract that isn't needed in the structure, maybe get that out while the remittance basis is still available. Get it out, put it in a separate structure. For I don't know, use in a rainy day, use when you've left the UK. So I think people could be looking at income extraction and rebasing exercises. But that's also, sometimes easier said than done, because it very much depends whether you've got a footprint in another jurisdiction, or whether the jurisdiction those assets are based in imposes any kinds of taxation on those events. But I think that's definitely worth exploring for the most valuable clients.
So I've got a sort of related questions for you again, Sarah. So often when we're talking to clients about the remittance basis and about domicile rules and whether they might become deemed domicile after the 15 years that we talked about, one of the strategies that we've often talked to clients about, and this is putting on one side for a minute the possibility of a change of government, is what we call excluded property trust. Would you mind explaining what we mean by those, and perhaps then comment on whether you think those could continue to be relevant either with or without a regime change, if you like?
Yeah. So we have now a deemed domicile rule that says that once you've been resident in the UK for 15 years, on day one of your year 16, so it's 15 out of a period of 20 years. So if you think about consecutive periods of residency, on day one of year 16, you become deemed domiciled in the UK and subject to worldwide taxation, income gains and inheritance tax. Before that 15-year rule was introduced and expanded to cover income tax and capital gains tax, it had been for many, 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 many years the rule that you would become deemed domiciled for inheritance tax purposes only once you'd been resident in the UK for 17 out of 20 years. And very standard planning in that respect was, in advance of becoming deemed domiciled in the UK, people would transfer their non-UK sited assets into offshore trusts. The status of those trusts was that the assets, being non-UK assets settled by a non-UK domiciled person, were so-called excluded property, and excluded property is outside of the scope of UK inheritance tax. So that continues to be pretty standard planning for inheritance tax protection purposes. People in advance of becoming deemed domiciled in the UK will stick their non-UK cited assets into an offshore trust. And regardless of the fact that they subsequently become UK domiciled or UK deemed domiciled, those assets continue to be protected from inheritance tax purposes. From an income tax and capital gains tax perspective, it was a deferral mechanism in that the income and gains that arise in respect of those assets will be taxable if they're distributed from the trust. That is the same under the 15 out of 20 year regime, where trusts that are settled before somebody becomes deemed domiciled in the UK are so-called protected settlements, and so are deferral mechanisms, effectively, provided that they're not tainted. So, even in the run up to the last, at the end of tax year, we were having conversations with clients who were saying, is it worth it? Is it dangerous to set up a trust now? What happens if this all changes? And again, it's crystal ball gazing. We don't have an answer to this, but, I would observe that the excluded property settlement planning has gone on for many, many years. And that when the income tax and capital gains tax rules have been tightened in respect of offshore trusts, and there's a history of this, 91, 98, 2008, 2017, there's always been grandfathering rules. So my suspicion would be, my best bet would be that the inheritance tax protection likely would continue. And that there will be some kind of grandfathering, in respect of income and gains, but that ultimately the income and gains deferral would be lost, because really, it's the income and gains that people are trying to get at, not the inheritance tax, I don't think.
So whenever we talk to clients about trust, I think most people who read about these things immediately start thinking about what the taxation might be within the trust. So just thinking about inheritance tax. So in an ordinary trust situation, we talk to a client about the price they might pay for getting something into a trust is 10-year charges, exit charges, etc. Are those things that we need to think about in the context of excluded property trusts?
Well, no, because for an excluded property trust, provided the settlor is not domiciled or deemed domiciled in the UK, and provided the assets that are transferred into the trust are not UK cited, there's no entry charge because it's excluded property going in. And then for so long as the assets within the trust remain excluded property, so non-UK cited assets, the 10-yearly charges and the other, the rest of the discretionary trust regime, won't apply. I guess there are caveats to that, which is, sometimes there are, inadvertent UK situa assets, appear, and that can mess things up. And also the real estate point, if you've got a trust that's got either UK residential property held through a holding company in it, or if the rules were to change UK commercial property, you can inadvertently end up with a UK situa asset in the trust, and then that will be, that will be taxed accordingly, either under the discretionary trust regime or also the gift with reservation of benefit, because excluded property trumps gift with reservation of property rules. But as soon as you've got a UK situa asset in there, that ceases to be the case.
So as things stand, they're still a really, really valuable tool. And
I think so.
Whilst we can't crystal ball gaze, we certainly would be engaged in clients about potentially using that tool in discussions we have now and any time in the next however long, So it's still very much on our radar, isn't it? That structure. I'm just going to throw one slightly random thing into the mix and maybe ask Catriona to comment first and then Sarah. So I was at an event recently that was led by some investment managers, and the topic there was similar, albeit they were looking at things like what impact it might have on the markets. And one very interesting point I picked up on was that this might be the first time, and might be the first time that actually a Labour win is something that the markets welcome. I've certainly never seen that before, and it seemed to be emerging from the themes that they were discussing. Catriona, just thinking about that, let's imagine that we have a sort of bounce on the back of a Labour win, and there is a Labour win. Does that in itself lead to any things, any discussions that we might have with clients now about values now relative to later?
Yeah, so again, I suppose that if I think there's a general sense that there is an artificial almost suppression in the markets at the moment. There's a lot of discounting going on, so people are carrying losses and haven't perhaps got the gains that they would have had previously. So if that bounce is likely to happen, and I mean there is an argument, I suppose it's got to happen at some point under either government, then it might be time to look at whether there are things to do with gains and perhaps crystallising some gains and utilising losses now. So I think there is planning there, and also whilst values might be a bit lower in terms of whether people want to look at the gifting side of things and moving things outside their estate before they increase. Because if the bounce comes, are we going to end up with a more aggressive taxation, perhaps around the inheritance tax planning? So again, I think it comes back to the point we were saying before. Now is a good time to be having conversations and just thinking about these things.
Yeah.
Well, I think that's a really good point to finish on, really, that now is the time to be having those conversations. I'm going to bring things to a close. Thanks very much to my panelists, and thanks so much to all of you attending. If this has prompted questions, please feel free to contact either the person you deal most with at Mills and Reed, or any one of the three of us. And if it's not a question for one of us, we'll take it out to the others. So thanks so much. Goodbye.